So this chapter we'll be talking about uh, receivables, particularly how to estimate bad debt expense and the collectability of receivables. So there's two different classes of receivables, accounts receivable and notes receivable. And we'll go through that. Mostly notes receivable are more defined agreements long term. And then how to account for uncollectible receivables, something that we don't think we're going to get collected from our customers, and then the different methods for writing off these uncollectible accounts and how that impacts bad debt expense, and then the reporting of that on the balance sheet and the notes to the financial statements. So receivables that come from sales on account show up like we've done the journal entries all semester now, and that's in accounts receivable. And that's because they're expected to be collected fairly soon. There's no formal written agreement, and there's no interest charged. However, the term receivables counts for anything that's expected to be collected from other people, other companies, other organizations. And generally, it's going to be a current asset because it's going to be collected within a year. But a notes receivable will be more like a payment plan, like buying a new washing machine, 12 interest-free payments or interest-bearing payments. That would be a notes receivable. An accounts receivable is just you buy it now, you get the bill, you pay the next month. A notes receivable is a more defined payment plan or pay it all a specific amount of time from now, like 90 days or a year from now. And as we've gone through, purchasing services on account creates an accounts receivable, or selling services on account. Selling services or merchandise on account creates an accounts receivable, usually collected within 30 to 60 days, and they show up as a current asset, where notes receivable are, much more long-term. They could also be used to settle a customer's accounts receivable. So if a accounts receivable isn't going to be collected and they go to the customer and say, hey, this invoice is due, when are you going to pay it? And they say, oh, well, we can't pay it now. Can we set up a payment plan or some sort of agreement? And then there's a notes receivable created to pay it off over the next 6 to 12 months. There's interest, there's specific payments, and it's all written down in this agreement. That would be a notes receivable, and we'll go over the accounting for that. And then other receivables are interest receivable, taxes receivable, and receivables from officers or employees. They're usually reported separately, and usually they're small enough that they're in the other category, like other current assets or other receivables. This comes about like if a company expects to get a tax refund April 15th, and they know that that's going to happen, that will be a current asset as of December 31st, because that would be taxes receivable, and they would account for that in their taxes provision. Otherwise, interest receivable would be interest accrued on notes receivable, if that's been accrued but not yet paid. And that's really all that we're going to go over on the other receivables. We're going to focus mostly on the accounts receivable and notes receivable today. And so if a receivable is going to be collected in 1 year, which one of these is it classified as? Yep, current assets. Awesome. And when selling services on account, the largest problem is the business going to get paid? And how quickly is it going to get paid? But as a part of that, companies have to estimate what's called a bad debt expense, or an allowance for doubtful accounts, to properly value the accounts receivable at the end of the period and also account for the fact that not all the revenue is going to be collected. And so that's the accounting requirement, but there's other, there's a lot of information on this slide also about when are the receivables going to be collected? Sometimes if a company needs the money now, they'll do what's called factoring the receivables, which is selling the receivables to a bank or some other entity to collect the receivables for them, and then they get the money right away. So if the receivables are going to be collected generally within 30 to 60 days, but the company wants an advance on that money, they can sell those receivables to a bank. And it can be a really stressful situation, companies running out of money, or they just want to have that money more quickly. They can sell those to a bank, and that creates more of a secured or asset-backed lending line or line of credit, which they would get a lower interest rate on that than if they got just a regular line of credit or a credit card or something like that, because it's backed by these assets that they're handing over to the bank. And when this can really go wrong, and I added this example, just First Brand, if you guys have heard of the First Brands fraud in the news lately, this is really all just within the last month. This company that was that had a whole bunch of receivables. They did car parts and auto lending, and they were pledging these assets to lenders as part of an asset-backed lending agreement to raise cash. However, they were pledging the same receivables to multiple different banks, and then they went bankrupt partly because the receivables were not getting collected. And then when they went bankrupt, 3 to 5 different banks come looking for the same receivables, and they pledged them all to different banks without clarifying who gets the money first. And it was this, and the fact that they were even pledged to other banks in the first place, and it was this whole thing. So that just gives you an idea of like what can go wrong in a factoring agreement. But generally, companies only even allow factoring of receivables or will even deal with it if the receivables are like very minimally have a bad debt expense. For example, like a company that factors a lot of receivables is Western Digital. They make hard drives. The receivables are always collected, and they just sell the receivables to a bank. They collect it immediately. It's done. So that's how it usually happens, but I wanted to highlight this because it's a hot topic in the news lately. And the expense related to uncollectible receivables is called bad debt expense or uncollectible accounts expense or doubtful accounts expense. But in this course, it's always just going to be bad debt expense. And they'd count an account uncollectible if it's past due, if the customer does not respond to attempts to collect, customer files for bankruptcy. These are all just indicators that an account is not going to be collected. It's not a guarantee, but they can decide to actually write it off because of a multitude of these factors. And if the customer doesn't pay, the company might turn the account over to a collections agency, and then it'll eventually get collected, or not, or they might just never see that money again. And so there's 2 methods to account for this. One is the direct write-off method, and it expenses to bad debt expense when the account is written off. And it's really only used by small companies with few receivables because this is not a GAAP method. Like, what if we sold a whole bunch of merchandise on account in December, and then come January, February, March, customers aren't paying? That bad debt expense has to be matched with the revenue that created it back in December. And so when the sales are made in December, we need to have an allowance for how much of these receivables are going to not be collected. And this is the GAAP method. And it's required with companies with a large amount of receivables or a large amount of bad debt expense. The only time the direct write-off method is even allowed is when bad debt expense or uncollectible accounts is so small that it doesn't matter. Um, and so just to go through a few examples of companies, Johnson & John, so MGM Resorts owns casinos like MGM Grand and the Bellagio in Vegas, and they had accounts receivable of 712 million and an allowance for doubtful accounts of 128 million. And Johnson & Johnson had 15 billion in accounts receivable and 230 million in their allowance for doubtful accounts. So we're going to compute the percentage for each of these. MGM Resorts had an 18% reserve for their allowance for doubtful accounts, and Johnson & Johnson had a 1.5% reserve. And, you know, there's a clear difference between these two companies and two industries, and it's really just because thinking of the results of MGM, like how would a casino have accounts receivable? They're letting customers gamble with more money than they have, essentially. Like that's the way this gets created. And clearly a lot of people can't pay. And that's going to get sent to collections and probably not going to get collected. People, go bankrupt or just never pay it or whatever. But that's a lot riskier than selling to Johnson & Johnson, selling a whole bunch of supplies to pharmacies or other drug companies or things like that. It's all about creating a risk profile for the particular company based on what's been lent in the past, what's been collected in the past, and it's really different just based on the nature of the company, but particularly the nature of the customers. And I can guarantee you that MGM Resorts has a credit department that when they're going to lend to a customer or sell services on account for Johnson & Johnson, they're assessing their customers for credit worthiness and how likely is it going to be paid back? What's the most, like risk mitigation standpoint, what's the most we're going to sell to them and the highest that we're going to allow their accounts receivable balance to get up to? Those would all be controls within the credit department. And so under the direct write-off method, if a customer can't pay, for example, DL or Ross can't pay the $4,200 accounts receivable, the debit would be to bad debt expense and the credit would be to accounts receivable because it's no longer an asset. We're not expecting to ever receive money for that, so we need to reduce that to zero for that particular account. And if an account is collected after it's been written off, so for example, they write off the account, they send it to collections, and then something comes back from the collection agency, then it would be recorded as a reversal. They would, under the direct write-off method only, they would reverse the bad debt expense and debit accounts receivable and then credit. They would reverse the initial entry and then they would collect it as normal. So they'd debit cash, credit accounts receivable. But if you reduce these journal entries, so to speak, it would be a debit to cash and a credit to bad debt expense, but they reverse the initial entry and then collect it as normal. And this is used really only by businesses where the amount of bad debt expense is so insignificant that they don't want to bother with creating an allowance for doubtful accounts and maintaining the uncollectible accounts balance. They don't want to deal with that record keeping. Like accounting is meant to represent the facts of the business. And If it's $1 million business and they only have $4,000 of accounts written off every year, it doesn't matter what method that they use. Like the financial statements are going to be materially accurate, even if it's not accurate to the pennies, right? So that's the only time that this is really acceptable to use. Now, the uncollectible accounts method is for when we don't know the exact accounts that are going to be written off and we accrue an allowance. For example, they sold merchandise and then they sold merchandise on account, they received $400 and determined the rest uncollectible, and then they reinstated it when it was then paid in full. Oh, this is more of the direct write-off method. So, right, they have the initial sale, and then $400 is the cash that's received, and the remainder is written off directly to bad debt expense, writing off the accounts receivable. Then, when the rest of it is eventually paid, they reverse the bad debt expense entry that was made, and then it's paid in full as normal. Now, under the allowance method, or we create an estimate of the credit losses, and it's recorded as an adjusting entry. For example, at the end of the year, the receivables balance is 200,000, and we estimate that 30,000 of the accounts receivable is going to be uncollectible. So we create what's called a contra asset account called the allowance for doubtful accounts. Much like the accumulated depreciation account is a contra asset account, allowance for doubtful accounts is also a contra asset account. And so on the balance sheet, either depending on how significant this balance is, it will be displayed as accounts receivable net, where it just subtract accounts receivable from the allowance for doubtful accounts. Or if it's really significant, if it's a bank or a credit card company, they might include their allowance for doubtful accounts or their expected credit losses as a separate line, but it would still be in the assets section of the balance sheet. And our journal entry to record this is bad debt expense and a debit to bad debt expense and a credit to allowance for doubtful accounts, which is still in our assets section. And on the income statement, right, that's where the $30,000 of bad debt expense is going to appear, because that's related to the current year's revenue. That's what generated this bad debt expense. So when the accounts are not collected next year, then it won't impact next year's income statement. So the 107, and then the valuation of the accounts receivable on the balance sheet is $170,000. That's the net realizable value of the accounts receivable, because it's the initial amount minus the amount that's estimated to be uncollectible. Then when we write off the accounts, we debit the allowance for doubtful accounts and we credit accounts receivable, right? So we reduce our accounts receivable and we also reduce our allowance. And so the impact on net assets is 0. And the impact on the income statement for not collecting an accounts receivable under the allowance method is 0, because we accrued for it last year, and so we're reducing our allowance. And at the end of the period, before the adjustment is made, the allowance for doubtful accounts will have a balance. And that's because it's an estimate. We can't estimate it exactly correct every single year. And so in the previous year, if we underestimated the allowance for doubtful accounts, then at the end of the year, it's going to still have a credit balance. The allowance usually has a credit balance, right? And so we estimated $30,000 is not going to be paid back, and then we only had to write off $20,000 during the year. At the end of the year, it's still going to have a $10,000 credit balance. But if $40,000 was written off, then we'd have a $10,000 debit balance. And accounting estimates, we do the best that we can at the time, but if we were wrong, there's no going back and restating. We just have to correct it and make sure that our accounts receivable are presented fairly going forward. So, right, we're at the end of the year, we're putting sort of accruing for allowance, increasing our allowance, and then throughout the year, we're decreasing our allowance as accounts are written off, and they're written off when they're determined worthless. So let's say that we have an account that we think we're going to collect 50% off of. We'd accrue for that. We'd take that into account when we're creating our allowance, but it's not actually written off until it's determined worthless. And so writing off an account has no impact on the income statement. It's only the allowance, the entry that has an impact on the income statement because that's what impacts bad debt expense. Right, and so we start in January with our $30,000, and throughout the year, as we write off all these customers' accounts for $26,750, then it slowly reduces our balance, and then our balance at the end of the year is $3,250. However, if they'd written off $32,000, then the ending balance would be a debit balance of $2,100. And after this is really like keeping track of whether it has a credit or a debit balance can be tricky, especially on the homework. And so it's really important to note, okay, this ending balance of 2,100, is that a debit or a credit? And after the entry, at the end of the year or the end of the period, the allowance for doubtful accounts should always have a credit balance. So in this case, if next year we estimate again that the end of the year balance should be 30,000, we're going to have to debit bad debt expense for 31,000, no, for 30,000, for $32,100 to bring it to 30,000, right? Because that's the credit for allowance for doubtful accounts that would be needed to adjust the estimate. So then the bad debt expense for this current year would be 32,100 because that's what was needed to bring our accounts receivable valuation to what we need it to be. Under the, there's, and then an accounts receivable that's been written off against the allowance could be collected later. So there is an entry that we can make we reinstate it. So we debit accounts receivable and we credit the allowance for doubtful accounts. And then we credit cash or we debit cash, credit accounts receivable in order to collect it. So we basically just reverse the use of the allowance, but this entry does not impact the income statement, only the balance sheet. And there's two methods that we can use to estimate the uncollectible accounts. And that's the percentage of sales method and the analysis of receivables method. But both of these methods use underlying assumptions that's created by the business to estimate the current expected credit losses based on past experience, industry averages, current economic conditions, and forecasts of the future. And just from a terminology perspective, if you ever hear current expected credit losses, especially in the banking industry, that can be abbreviated CECL or CECL. That's what a bank would use to describe that, but we're always just going to estimate it as uncollectible accounts. And the percent of sales method is relatively simple. We just have our total credit sales for the period of 3 million. And then we estimate that our bad debt expense is going to be 0.75% of the 3 million. And it's just a simple multiplication to get our bad debt expense for the year of 22,500. And then we credit our allowance for that amount, and then we debit our bad debt expense for that amount. And I mean, this is a gap method of determining what the accounts, like what the balance should be. However, eventually, if the credit balance, this is more of an income statement focused approach compared to the next approach. If the balance at the end of the year was unreasonable by looking at it, like especially if we do this method and it was wrong last year or wrong this year, we could take a look at it at the end of the period and adjust based on that, especially if our allowance for doubtful accounts had a debit balance at the end of the year because we didn't adjust enough, or a debit balance, particularly after making our adjustment, and it was an unreasonable valuation of our accounts receivable, then we'd have to make sort of a special adjustment. But usually that wouldn't happen, and I don't see that happening in the homework or anything. But on the percent of sales method, this is our T accounts. So we have our bad debt expense of 22,500, and then throughout the year, right, we have our initial balance of 30,000, and then all of our write-offs, unadjusted balance of 3,250, and then our adjusted balance of 25,750. And our estimate of bad debt expense is credited to whatever the unadjusted balance was for the allowance for doubtful accounts. Now, the analysis of receivables method is a more balance sheet focused approach, and we take a look at all of our accounts receivable and estimate how much of it will actually be collected. And this is the method that is most commonly used in industry, especially in bigger companies, especially in what's called this aging of accounts receivables schedule. So we have a days past due, and then either they're not past due, 1 to 30 days, 31 to 60 days. And as receivables get older, they're less and less likely to be collected the more amount of time has passed since the due date. And each of these due dates then will assign a percentage of what's actually going to be collected based on how many days past due it is as part of our analysis. And that's what's called aging the receivables. And so we're going to take a look at this aging schedule of the receivables here. We have each customer and the balance from each customer. We have a total receivables balance of $240,000, and we have not past due, 1 to 30 days. And as you can see, the percent uncollectible for each of these buckets is different. And then if a receivable is over a year old, only 80% of it is deemed uncollectible. So only 20% is what we'd think that we would collect. And those percentages can be adjusted, of course, based on the history of their company, how collectible are um, have accounts been in the past, and so then when we create our estimate of uncollectible accounts, we add up all of the percentages for all of our buckets, and we get our estimated uncollectible accounts of $26,490. And the key to this is this $26,490 is not our bad debt expense for the year. This is what we want the allowance for doubtful accounts to be at the end of the year. And we compare the estimate of what we want the allowance to be to the unadjusted balance of the allowance, and we make a journal entry to plug what journal entry is needed to bring it to that amount. And so if you remember, our initial balance was $3,250, and that's a credit balance. We need to make a credit to allowance for doubtful accounts of $23,240 to bring it to $26,490 to adjust. So our bad debt expense is going to be $23,240, and our allowance credit is going to be $23,240. Um, and so this is a summary of our T accounts here. And at the end of the period, our adjusted balance is what we decided on for our valuation. And that's why it's considered more balance sheet focused, because we take a look at the balance sheet and determine what are these accounts receivables worth, and then the bad debt expense is the difference. Do you guys have any questions on this? Like this is the premise of essentially the entire chapter. We're going to go through some examples, but we take a look at our receivables under the allowance method, and we assign how much of these are going to be not collected, and we create a balance, which is our allowance for doubtful accounts. And we usually have a beginning balance for our allowance for doubtful accounts, which is $3,250. And then we have to make an adjusting entry to bring it to that valuation. That's the key. And right, if the unadjusted balance was a debit, we would need more credits to balance it out, which would increase bad debt expense. And so the percentage of sales method puts more of an emphasis on the income statement. It is, this is the amount of our credit sales during the period. Generally, 0.75% of our credit sales are not collected. And so we're just going to estimate bad debt expense based on that. And then the analysis of receivables method, we take a look at the AR on our balance sheet and consider the creditworthiness of each of our accounts and to determine the net realizable value. And so in this method, under the percent of sales method, our bad debt expense was $22,500. And then under the aging or analysis of receivables method, it was $23,240. So it's a difference of almost $1,000 based on the estimation method. And it really just depends on what the business determines is most accurate and the easiest method that they can perform as an accounting team while being the most accurate. Because the percent of sales method is easier, right? All you do is multiply it by sales, make your adjusting entry, but then the analysis of receivables method, that's more be more important, especially if the amount of receivables at the end of the period is really big, or the bad debt expense is usually quite large. The customers might not be as creditworthy, or there's a lot of stale or old accounts receivable, then it would be much more important to use the analysis method. I've only ever seen the analysis method used by businesses, by the way. So, um, Apple Valley Furniture uses the following method to estimate bad debt expense, and this is its information at the end of the year. And so we need to take 0.5% of 1,765,000, which would be which would be $8,825. And so that's what we debit to bad debt expense, and then that's the credit to allowance for doubtful accounts. And then after the adjusting entry is posted to a ledger, the ending balance is 10,675. And using the allowance method, they sold merchandise on account. They received 10,000 and deemed the remainder uncollectible, and then they received the full cash payment. None of this is actually going to affect bad debt expense at all because they're using the allowance method. And they accrue the allowance as an adjusting entry at the end of the period. And because this is all stuff that occurs during the period, none of this actually impacts bad debt expense during the period. It might impact our calculation and our adjustment at the end of the period, but right now we have our initial debits and credits for the accounts receivable, sales, cost of goods sold, inventory. And then when we collect 10,000 and deem 17,250 uncollectible, then we debit our allowance then and we credit our accounts receivable, so reducing them both at the same time, which has no impact on net assets because this entry here has zero impact on net assets whatsoever because cash and the allowance are debited and then the accounts receivable is credited. And then when they collect it, after they've written it off, they have to reinstate the accounts receivable. So they debit accounts receivable, credit the allowance, and then debit the cash and credit accounts receivable as you would normally collect an accounts receivable. And another example of using the direct write-off method compared to the allowance method for writing off an account. Under the direct method, we debit bad debt expense directly and then credit accounts receivable. Under the allowance method, we debit the allowance and credit the accounts receivable. And so for this example, at the end of the year, the accounts receivable has a debit balance of 1,935,000. Sales for the year were 26,710,000. Determine the amount of the adjusting entry to provide for doubtful accounts under each of the following assumptions. So assuming that the allowance, assuming that the bad debt expense is estimated at 0.5% of sales, we take 0.5% of the sales amount of 26 million, and we get our bad debt expense of 133,550. If we use the aging method, and the ledger determines that the allowance is 175,000, and then the before adjustment, it has a debit balance of 10,200. That's just a really bad marker. Right, so we have our allowance for doubtful accounts, or ADA, and we have an initial debit, and this is why it can be really useful to write this out. And our desired ending balance is 175,000. We need to have our credit be more to cancel out this debit. And so our credit is 185,200 because we determined based on our aging schedule that this is the valuation adjustment that's needed. This is what needs to show up to accurately reflect our accounts receivables net realizable value at the end of the period. And to get it there, we plug this as bad debt expense and as allowance for doubtful accounts credit. And then this is just our initial balance. And you need to make sure, right? It can be really helpful. I really suggest writing it out on paper as you're doing the homework or the quizzes, to have your T account so it's really clear and you remember to check is it a debit, is it a credit, at the beginning of the period, and then we know our ending allowance. So that can be really useful. Assuming that the bad debt expense is estimated as 0.75% of sales, we just simply multiply our sales amount by 0.75%, and we get 200,000. And that would be a simple debit bad debt expense for 200,000, and then credit the allowance for doubtful accounts for 200,000. And then under this example, assume the allowance initially had a credit balance of 25,760. And the aging method determined that our estimated doubtful accounts needs to be 170,420. Then the difference is what needs to be our adjusting entry. So that'd be 144,660. That's what needs to be our adjustment that's made at the end of the period to bring our estimate to the correct amount. And the entry would be a debit to bad debt expense and then a credit to the allowance for doubtful accounts. Now, when calculating the number of days past due, we take so the credit terms are net 30, which means that the account is due 30 days after the invoice date. And so it's there's 3 different dates that can be involved, right? There's the invoice date or the date of the sale or something like that. And then there's the due date, which would be 30 days after the invoice date, which the invoice date isn't shown here, but the due date is shown. So if the due, and then there's the current date, and the current date is as of October 31st. And then we have all of our different amounts. And so we can calculate the amount of days past due October 10th is only 21 days past due because it's October 31st right now. But August was 74 days ago, May 159 days ago. So we calculate our days past due based on the due date, not the invoice date. Because if the terms were net 30 and the invoice isn't due yet, we have on our schedule here, we have a not past due column. So for this business, if it's within that net 30 period, it would be in the not past due bucket. And then 1 to 30 days, 31 to 60 days, 61 to 90 days, and over 90 days. If you're asked to do this on the homework, I mean, I suggest using a date between calculator, or just looking at a calendar, and it's like, okay, how many days are in between here? Because right here, right, we're adding up all the different months. So for June, we have the days in June, July 31st, August 31st, September 30th, and then October 31st. That's the days between. I mean, it's not rocket science here. But it's just a lot of details to catch, right? And so we're putting each of these into a bucket. And then on the customer ledger for all the accounts receivable, we would have each customer laid out, and it's like, okay, what is the total accounts receivable for each customer? And then how many days past due is it for each customer? So for example, Boyd Industries, the due date was April 7th, and that's 115 days past due. So that would be in the over 90 bucket for the $36,000. And the not past due Lockwood Company balance for $7,400, that would go in the not past due category. Then we take our valuation for each of these and our estimated amount that's uncollectible. So we have not past due, we say 1%, 1 to 30, 3%, 31 to 60 is 12%, and then 61 to 90 is 30%. And we multiply that on the total receivables that are in each bucket. And so we have to take all of our receivables and add them up. And then we get our allowance for doubtful accounts, and we have each bucket has its own balance. And so when doing these, I would recommend writing it out on paper so that you can keep track of all your intermediate calculations, or using Excel or Google Sheets or something to speed up these calculations and make sure that nothing's lost in your head while you're doing all these. Because just to this one problem, the concept is fairly simple to understand. We're estimating, based on these buckets, how much is uncollectible. But there's just a lot of calculations involved. There's a lot of room to make mistakes in these problems, a lot. And so I just highly suggest writing it out or typing it out in some way to keep track for yourself, to make sure that you're not slipping up. And also there's multiple intermediate points where you can check when you total all of your accounts receivable in each bucket. Make sure that the total accounts receivable that you've calculated matches the total accounts receivable that the problem initially had, so that you know that you didn't miss any bucketing, for example. And then we estimate our allowance at 106,106. And, unfortunately, this problem doesn't have an example for the journal entry, but depending on the beginning balance, we would have this 106,000 as our desired allowance for doubtful accounts, and we would make our adjusting entry to plug it, to get it there. Using the data in exercise 8.9, assume that the allowance has a credit balance of 8,200 before the adjustments, and then make the adjustment. So we have our 8,240 as our initial balance. And then our desired balance was 106,106. And so the amount plugged to get our bad debt expense and our allowance for doubtful accounts is $97,866. And that, so the bad debt expense of 97,866, that's what's actually going to hit our income statement for the period. And so this example, they give us the amount of accounts receivable in each bucket, and we need to estimate the allowance for the end of the period. And so what we're going to do is multiply each of these amounts by the percent uncollectible, and then we'll get our allowance amount. So 0.75% of 902 is 6,765. 80% of $15,500 is $12,400. And so we have to multiply out each and every one of these and then add up the total to get 63,195. And so let's just record this. We have our balance, excuse me, 63,195. And then let's see, our beginning balance is 6,225, and it is a debit. And so that's really important to note. I was about to write it down as a credit. And so the difference is going to be 69,000 like 410. Because that's the difference. It's actually 69,420. And that's because right, that's what was needed to plug our allowance for doubtful accounts to the amount that we estimated is going to be uncollectible. And when it's a debit balance for the beginning balance, we add the debit balance, and then when it's a credit balance, we have to subtract. So the following transactions were taken from the records of Hobbs Company for the year ended December 31st, 2026. And so we wrote off the account so initially wrote off 3,650 and then received a partial payment and then wrote off the remaining balance. And then we received a previously recorded uncollectible balance. Then we wrote off all of these accounts as uncollectible. Then we used the percentage of sales method to estimate that 1.25% of the credit sales are uncollectible, and we had 3,400,000 of credit sales during the year. So notice how it says credit sales during the year, and the estimated, whatever method that the company decides to estimate it by, it's really important to watch the wording. So it says 1.25% of credit sales. So if the problem said they had 3.4 million of credit sales and 600,000 of cash sales during the year, we would only multiply the 1.25% times the 3.4 million, because that's the credit sales, that's the method that they told us that they're using. If they said 1.25% of total sales, and then they had total sales provided, we would have to multiply by total sales. And it really depends on, right, they're looking 3 years back. How much has been uncollected? And if when they're making that estimate, if they're using total sales, then when calculating bad debt expense, they would have to use total sales. If they're only looking at credit sales when they're making their analysis, which is right, that's a much more detailed, like, initial estimate and initial allowance is only using credit sales, because cash sales, it's cash. It's never not going to be collected. They received it in cash. If they're using credit sales in the estimation and creating this 1.5%, then we would have to multiply only by credit sales. But it really is, it depends. It all depends. Depends on what are they using to create this estimate. And that's why in the homework, looking at the wording is really important, right? If it says credit sales, we have to multiply only by the credit sales. And if it says total, we need total. And so we have a lot of journal entries for these 5 different transactions here. The initial entry, and they're also different, right, based on the allowance method and then the direct method. So under the direct method, when we write off the account, we write off bad debt expense and then credit to accounts receivable. And then under the allowance method, we credit our accounts receivable, but then we debit our allowance for doubtful accounts. Then under the second entry was a customer paid partial payment, and then the rest of it was deemed uncollectible. So we write off the amount that's uncollectible, and then we credit our accounts receivable for the full amount. But the difference between the two is one debits the allowance, one debits bad debt expense. And then collecting a previously uncollected account, we have to reverse the initial entry. And reinstate the accounts receivable first. So the accounts receivable under both methods is debited, but under the direct method, it's bad debt expense is the credit. And then the allowances method, the allowance is credited. And then we collect the cash as normal with a debit to cash. And then writing off all of these individual accounts at once, that's right, it's the same credits to reduce the accounts receivable for both, but then under the allowance method, we're debiting the allowance, because when we write off accounts, we're never touching bad debt expense in the allowance method. And then creating the allowance as of December 31st, the adjusting entry, no adjusting entry for the direct method, and then we create our adjustment by taking the 1.25% of sales, of credit sales for the period. We get our bad debt expense of 42,500. So really the only companies that use the direct method are small companies or companies with very few receivables. Think of a restaurant that is receiving all of their money in either cash or credit card. The credit card could be considered a receivable, but generally not. Generally, it's just considered cash that's just goes straight to their, especially if it's a small business, goes to a Square account. But if a customer charges back the money, right? Like if they get just really mad customer and they just say they call up their credit card company and they cancel the charge, that's going to create a bad debt expense for like $20 or whatever petty amount that they're doing this over, right? And that would be a bad debt expense. But $20 doesn't matter. If they're having customers call back for $20, $100 a month, it really doesn't matter. And so they can just use this direct write-off method to write off the bad debt expense as they go, and probably just gets buried as other expense in their income statement because nobody cares. But in big companies with large balances, it really matters, and they'll use the allowance method. Also, if a company is using cash basis, none of this matters at all because under cash basis, there's no accounts receivable because they're only recording the revenue when they receive the cash. So we're going to take a look at another example comparing the direct method to the allowance method. So we have a number of transactions, and under the allowance method, we're estimating 0.75% of credit sales are uncollectible, and Shipway recorded 3,778,000 during the year. And so how much higher or lower would the net income have been under the direct write-off method rather than the allowance method? And under the direct method, this is all of our entries. And the only entries that actually impact net income in this situation are the write-offs, the direct write-offs. And so we have our initial bad debt expense, 6,600, and then we have a bad debt expense, right? So we have the account that wasn't collected, that we wrote off, but then we collected it. So the April 13th and the 27th entries, they cancel out because they're a debit and credit for the same amount of bad debt expense. And then so we had our 6,600 of bad debt expense and our 13,510 of bad debt expense. So our total bad debt expense was about $20,000, 6,600 plus 13,510. And then under the allowance method, nothing impacts bad debt expense except our adjusting entry at the end of the year. And that was our total sales times 0.75%. And so that's 28,335. And so the difference is about $8,000. And that's because this difference is the amount at the end of the year that we're estimating is still not going to be collected, right? This would be the company would essentially be overstating their net accounts receivable balance because they have a balance of accounts receivable, and we don't actually know what that number is right here, but 8,225 of it likely isn't going to be collected, and they need to accrue for that in the current period. And so under this method, they're using 1% of sales would be uncollectible. During the period, they wrote off 48,600, and they had net income of 712,000. So under this period, they expect 1%. That's going to be about six. So the initial reported net income was 712,500. And so to calculate what the net income would be, we would take 1% of that, which is 67,000, and then subtract that from 712,000. We'd have to add back the direct write-offs because those are not done in the allowance method. Those don't impact net income under the allowance method, but they do under the direct method. So we have to add back the 48,600, and then we subtract the amount that was actually taken away, and then we get 693,700 would be our new net income. And then under the next example, we have they had sales of 7,450,000. They wrote off 52,000 in accounts using the direct method, and then they had net income of 800,000. So if they used in the second year, if they used the allowance method using 1% of sales, have been used in both the first and second year. So this is the same problem as before. And if we're using 1% of sales this year, then our net income, we'd have to add 52,000 to the 800,000 and then subtract the 74,000 that we determine under our allowance method. But if we did not, the balance of the allowance for doubtful accounts would have been at the end of the second year if the allowance method had been used in the first and second years. So our initial allowance was 67,000. And then we wrote off 52,000 and then added, our initial balance was 67,400. We wrote off 48,600 last year, and then we added 74,000 this year, and then we took away 52,000 once again this year. So our ending balance is 41,300 would be the ending balance of our allowance at the end of the second year. And I think it'd be helpful just to write this out. So under the percentage of sales method, we're directly estimating what the allowance is going to be. So at the beginning of the first year of business, we have a zero balance to start. And then over the year, we debit throughout the year. We keep on debiting the write-offs, and then we make our adjustment, 67,400. And then our ending balance is the difference between the two, which is about 19,000. And then throughout the next year, we debit 52,000 of debits, and then we have our adjusting entry at the end of the year is 74,500. And then we get our ending balance of 41,300. So that's how this process works for the percentage of sales method of estimating.